Joining us now, Chris Versace, Chief Investment Officer to Monica Research, Portfolio Manager of the Street Pro Portfolio. Chris, thank you so much for joining us today. All right, before we get into market reaction, let's talk a little bit about this latest jobs print. ADP showing just 54,000 jobs added. What's your take about what that signals about the state of the job market and where it leaves investors?
Well, I mean, look, Diane, clearly it's a slower number than what the market was looking for, almost by half compared to what it was the prior month, even after we got the revisions from ADP. And I think when we take a look at the figures for August and we look at, the revised figures for July, June, and so forth, and we kind of do a 3-month moving average to smooth the data a little bit, we are seeing, without question, a much slower pace of job growth than we saw earlier in the year. It's not contracting, right? There are no net job losses, but when we take a look at Doge, we take a look at some other store closures that are happening. Clearly, the pace of hiring has slowed dramatically, no question.
So initially, futures popped off the back of the data, and now we're just above the flat line, and S&P minis just up 0.1%. Does it feel like we're just waiting for the NFP print?
I actually think we're waiting for the ISM Services print first, and that'll be out at 10 o'clock. And the reason I say that is, we got the ISM manufacturing report, but manufacturing's 10, 15% of GDP. So what the ISM data shows at 10 in terms of hiring, and more importantly, on inflation, I think that is going to really determine how the market trades today. It's no secret, Diane, the Fed is trapped between, is the job market slow enough to warrant a rate cut? But we've got either sticky or accelerating inflation, depending on the source you want to look at. And I think it's going to come down to, what do we see at 10 o'clock? What do we see at 8:30 tomorrow, candidly?
Okay, let me ask you this, Chris. One of the things that my colleague Kevin Green pointed out about yesterday's trading was the fickle nature of volume yesterday. So we ended up with a mixed finish. The gains, though, a lot of that powered by Alphabet, Google, Apple, right? And what happened there. What does that tell you about where things stand in the market? Should we be prepared for more choppiness in September?
I think that, Kevin's comment about the lower volume is exactly what we're talking about this morning, right? We're waiting to see, what does the cumulative data this week suggest that the Fed might do later this month. And again, it's going to be a very close call. Even consider what we heard just yesterday from two different Fed officials. Waller saying, we're ready to cut rates. Bostic saying, inflation, oh man, that is a big concern. I only see one rate cut this year. So it is going to come down to the wire for the market, because the market likes certainty, and we don't have certainty about what the Fed is likely to do, not just in September, Diane, but remember, the market is expecting 3 25 basis point rate cuts before the end of the year.
So I'm just talking to Ben Emmons, and he said if the jobs report comes in, let's say, for instance, much weaker than expected, because let me give some context here. The CME Fed Watch tool now expectation is above 97%, just above 97%, that we'll see a cut in September. Now, he said that at those odds, the expectation is a 25 basis point cut. But if it's weaker than expected, if it comes in over 100%, we could see a jumbo cut. What's your thought on that?
I think it's possible, but I don't think the Fed is really inclined to do it unless we see like a deeply negative number on the NFP report for August, because the inflation numbers are just, continue to move in the wrong way. We've got more companies announcing price increases as they start to restock their inventories. So I think the Fed is going to be very concerned about that. There's been talk of maybe a 25 basis point hawkish cut. I think we'll have a better sense about that once we get the ISM data at 10 o'clock.
Okay, and then where do you think this leaves us as we head towards the final few months of the year? Do you expect to see more funds coming into equities with the potential for a push, even if September ends up being weak like we've seen historically? Could you see a push in the year end of increased valuations in the S&P 500, for instance?
It's a great question, right? September tends to be a seasonally challenging month, let's call it. October, November, December, seasonally strong. So there tends to be that melt up from a historical perspective. I think the tough part about this this time around, Diane, is you've got the S&P 500 last night's close, 24.1 times 2025 earnings. We've talked before about how those expectations for EPS growth have been coming down for the back half of the year. So, could we see a little bit higher, call it 6,600 maybe? Yeah, sure, possibly. But to see an outsized move, we've got to see that earnings growth start to rebound, and we just haven't seen it yet. So I'm a little cautious on the market, but remember, at the portfolio, we buy individual stocks, not the market.
Okay. All right, Chris, we'll leave our conversation there for today. That's Chris Versace, Chief Investment Officer to Monica Research and Portfolio Manager of the Street Pro Portfolio.